guys, welcome to the Practical Wealth Show. Hey, and today we're going to talk about, cash flow management. And guest today is a young gentleman who has actually been crushing. I think I've known for 5-6 years.
Probably.
Yep. About 5-6 years. His father, Trent, this is Brock Fortner. First of all, his father, Trent, is actually my coach. And so I'm excited. He's become a really, really, really strong advisor in his own right, crushing it. And then, so for y'all young people looking at a career stuff, he is proof positive that you can come in looking like you're 15. When he first came, he looks better than that. He looks older than that now, just a tad, but it's still crushing it. It's a few things that I think impressed me. He's the youngest, or he might not still be youngest, but he was the youngest person. There's a great podcast called The Lifestyle Investor. And he was the youngest person to join that, and now as a fixture in that community with Justin Dahl. I highly recommend checking out that show. And so Brock, tell them about yourself. Tell them what I didn't tell them, and then let's help these people get control of their money.
Thanks for having me on, Curtis. I would say that you covered it pretty well. Yes, I've been in the industry for 10 years now come September, which is crazy to think about.
Okay.
But I mainly work with families, business owners who are making over 450 grand in a couple different areas: cash flow, protection, and then growth, and making sure that we align everything so that as we build your wealth, you can enjoy retirement or your distribution years and be able to spend and enjoy all of your money without the fear that you're going to run out of money, and then be able to pass that on to the next generation up to 100% to who you want, how you want to, and when you want to. And so I work all across the country in a virtual practice. And, I'm in Nashville, by the way. Yeah, I'm in Nashville. Yep. I know you love Nashville. So
I love Nashville. So any excuse I get to go there, conference, there it is, like, all right, when I can get there, I'm there. Right.
That's right.
Brock will take me down to
Broadway.
That's right. And, usually I stay out longer. It's all right. Let me go. I can get back. So
That's right. Now I just moved closer to the city, so who knows what might happen now.
All right. We know I'm coming back. So I want to kind of tee you up and start this off. So most advisors talk about investments, rates of return, and retirement, but you say all wealth stems from free cash flow.
That's right.
Wow. Elaborate on that a little bit. So I want them to get the frame of where you're coming from.
Great question. So I always say all wealth is created through free cash flow, because if you took everything out of wealth and just boiled it down to one equation, it would be inflow minus outflow equals free cash flow. Right? So income coming in, income minus expenses equals free cash flow, whatever's left over, right? And if you don't have any free cash flow, no wealth is being created. It doesn't matter what you look at, right? If a business spends as much as they make, there's really no business. There's no wealth is being created. If you buy a mutual fund and the return doesn't outpace the fees, there's no wealth being created. If you win the lottery and you spin the lottery, there's no wealth created, right? And so in our own financial lives, I always talk about the fact that at the end of the day, it all boils down to inflows minus outflows equals free cash flow. And what does that mean to you, and how does it show up in your own financial life?
What's the difference between being wealthy and simply having high income?
I think that's a great question. So first, when I talk about wealth, I think my definition of being wealthy is your ability to be present, right? How present?
I'm glad you brought that up. Your ability to be present.
Yep. How present can you actually be in a moment with the things in life that you actually enjoy the most, right? And so a high income doesn't always mean you're rich, or doesn't mean that you're wealthy, right? A high income just means you got a lot of money coming in. But if you're spending all that money, that just means you don't have nothing, right? Because I know people, I work with families that just this week, the family, it's a husband and wife. They don't have any kids yet, but they make just north of $50,000 a year, and they save, $28,000 a year. They save a lot. Now they live in a part of America that doesn't, that doesn't cost that much to live. But I also work with a doctor who makes $1.4 million a year, and they don't save that much.
Hmm.
Right. And it's not because they live in like New York City and they have to pay all this money to taxes and all the things. Like it's because car payments, eating out, all the things that add up over time to where, hey, we had this thing called lifestyle creep show up. And every time our income increased, our expenses increased, and a luxury once enjoyed became a necessity. And now they have a high income, but they're not rich, and neither are they wealthy.
That's I like the idea of being present. I like that too. If I go to away, if I'm still need to talk to the office, or I'm thinking about, instead of playing at the beach with my kids, I'm worrying about this thing over here. I'm not present, right? That's my and I'm better, but I'm still that way a little bit. And my goal in working with our clients is to help you be present,
That's right.
And so that's if the thing, if I took away someone's paycheck for 6 months, the question is, or I'm starting to ask, is would your financial system survive? And most times
no, not at all. That's a good question.
So they're not wealthy. What does Robert Kiyosaki say? Wealthy is how long you can maintain your standard of living with no income coming in. That's wealth. Right. So if you got a month, you're 1 month wealthy.
That's right. That's right. Yeah, I think it is him that says that.
So let me ask you a question. So why do so many six-figure earners still feel financially stressed and sometimes even insecure, in your opinion, based upon your work?
No, you're in some incredible questions, Curtis. Wow. So the way that I think about this,
I'm a bad man.
is, yeah, you are. So when you think about it, right? I always talk about, and I think I actually got this from you. I may have gotten it from somebody else, but what you become aware of, you can measure, you can track, and what you can track, you can improve. Reality is most people aren't aware of what's going on. Because if you ask most people, right? Oh, how much money is coming in your door? They'll tell you what salary is, their gross salary,
right?
And what they signed up for. They say, oh, well, I make $200,000 a year, but what actually hits their account might be $140,000 a year. But if you're living a $200,000 lifestyle and $140,000 of income, we have a problem. And so, when I think about this, right, the way that most people have their cash flow structured is when they get their paycheck, they receive their paycheck, it gets deposited into their checking account. Now, that checking account is the account that they pay all of their expenses from, they pay their credit cards from. And then, if we labeled that, it's an expense account. It's not to hold money. It's not to do really anything other than pay for expenses. Right. And so as you go through life, you might say, oh, okay, well, I need to save some money. So in that checking account, you'll do some mental calculations. You'll move the money from your checking into your savings account. Life happens, and then you move the money back from your savings into your checking account.
Right.
And you're living in this world of unconscious consumption while trying to manually save. Now, this back to, you'd have to think about this a little bit, but it goes back to your childhood days, right? If I look at my childhood, I remember I would go to the bowling alley or a field trip or the ballpark or somewhere, and my parents would hand me money, and they'd say, hey, this is your spending money, right? $5, $10, $20. This is your spending money for the day, for the weekend, whatever it is. So in our brain, we knew, hey, this is meant to spend. This is meant to take care of the things that I need.
Right.
And it didn't happen one time in our life. It actually happened like multiple times over and over and over and over again in our most developmental years of our life. And so in our brain, you can think of it as like a little ski slope. Over and over again, we built this ski slope in our head that says when money is handed to us, we're supposed to spend it. Right. And so as we got older, all we did was we just went from parents to payroll. And now what's happening is our payroll is handing us that same money at a bigger rate. And so as our brain sees it show up in our expense account, our brain registers, hey, we can spend this.
Right.
Right. So most six-figure earners, they started off at, when they started off, they didn't have a six-figure income. They started off with a low income, and it built over the years. But as it built over the years and it went into their checking account, so did their expenses. And now their expenses are rising to the same level as their income. And because they're not aware of it, that's where a bunch of the stress comes in. But once you actually get to take a step back and say, I know how much money is actually hitting my account, I know how much money is leaving my account, it becomes a lot less stressful.
So this quote I'll say from I'll give the who I got it from, Myron Golden. He says, if your outflow exceeds your inflow, then your upkeep becomes your downfall.
That's right.
And people don't track it. Like, we don't like budgeting, but if you're running a household, like I always tell people, you're the CEO of your life. And if you're not what business that doesn't track what comes in and what goes out, how long are they going to be in business?
That's right.
And what's the difference between them and you? Nothing. And you can't tell. Listen, when we talk about, we'll go back into I'll come back to that because let me ask you this. So do you think in terms of their gross revenue, and you say, all right, well, we in model, one of the models he works with is talk about saving 15% of your income. Do you do that on gross or net?
Gross.
Okay, I'll do that too. I was making sure I was thinking in the right way. All right. And as we both kind of rail again, I don't know if I should. I'll say, kind of go against a little counterintuitive to traditional financial planning. Mm-hmm. And what do you think the biggest mistakes traditional financial planning makes with a lot of the clients that might be hearing this if they don't work with us already?
Great question. They only have 2 solutions. They might have 3, right? So whenever you look at traditional or typical, I like to say typical, not traditional, typical financial planning, right? You're going to go in and you're going to figure out, how old are you today? When do you want to retire? How much do you want to retire on? And how much do you currently have? That way they could plug it into their calculator, future value calculator, grow it out, and then say, at that age, here's how much you need to support the lifestyle you think you want, and then how much you need to save currently. And every single time it's going to say, oh man, you are off.
Right.
So we, as a team, need to budget, cut a bunch of expenses out of your life so that you can save more, or we could take on more risk. Right? So for typical financial planning, those are really the only 2.
Yeah, only 2. Yeah.
Right. Budget, cut your expenses, sacrifice today so you can save more and maybe hopefully have more later. Or, hey, we need to increase your return, your risk, and get a higher return somewhere, right? They might also throw in there every once in a while, I could do it for cheaper. Or they might say, hey, you just need to grow your income, right? Well, if you grow your income and you don't have the right structure in place, we already see how that's worked out. Right. You're then going to have more expenses, right? If you look at most people's financial lives today, right? Let's say that you're an average American and you save 4%. And I'm not making that up. You can look it up. Average American saves 4% of their income. If you look at somebody that is making 100 grand and they're saving 4%, that's 96 grand, right? If they want to save 15% of their income, they have to go from 96% to 96,000.
Right.
That's $9,000. I don't know too many people that could just be like, boom, that's easy. $9,000. I can cut that out of my lifestyle right now.
Right. Yeah.
Budgeting is only good up to an extent. And what's funny, typical financial planning, like everybody wants to talk about certified financial planners, CFPs. This is kind of funny. Total side tangent here. Budgeting used to be a part of their curriculum for the CFP. And guess what's not a part of the curriculum anymore? Budgeting. Because it doesn't work. It's proven like it does not work. It's a good exercise. It just doesn't work. And so they actually took it out. So when I think about, typical planning, like that's the only thing that they can do is budget, which doesn't work, or increase your rate of return. So all of it always comes back down to
which the only way to do that is to take more risk.
That's right. And all they can talk about is products.
Right. And we view risk as probability of loss. That doesn't mean that you're going to make money. That means you're just taking more risk, which means you're more apt to all that. All he talked about there, we in our system, we call it the accumulation theory, which is based on we tell people, look, we're not in the lifestyle reduction business. So I'm not here to tell you can't go to Starbucks or whatever. Right?
Yeah.
So the segment I'm calling it, these are the questions I'm asking what I call the wealth lie, right? So this is a variation on the first question, but can someone have $1 million net worth and still be financially fragile?
Ask me that one more time. Can someone have $1 million?
Net worth and still be financially fragile?
100%. Because you think about it, right? Everybody wants to talk to you about your net worth. Like that's the goal. How do you have a nest egg, a net worth at retirement of $1 million, right? So let's say that you make 100 grand today, you spend the 96,000, right? But on average, let's say that your income grows at 4% and your expenses grow at 4% over that 20, 30-year period. Well, if you save up and you end up at retirement with $1 million, but you spend $150,000, that money's not going to last in your retirement for more than 10 years, even if you're earning a rate of return, right? Which most people try not to take more risk when they get to retirement because they need that money to last. Right. And so, yeah, you can absolutely be financially fragile with $1 million net worth, because if your income stops and you need to start spending that net worth, how long is that net worth going to be around for you? Is it going to last as long as you do, or are you going to run out of money before life?
Right. I always say you can't eat equity.
Can't eat equity. That's right.
Can't eat equity. And so let me. So the last, I put these into my mind. So why do real estate investors, what do, in your opinion, understand about cash flow than most families don't? What do they than regular people?
They get that. They own what we call cash flow engines, right? Things that produce income tax more efficiently than your paycheck. Well, for a real estate investor to have income, their rents, their inflows on their property have to be more than their outflows, mortgage and expenses, right? So they know, like, they can't support their lifestyle, or they can't create the income that they want unless their rents are higher than all their expenses. Right. So I think that's kind of
they one think of from our, like, I always tell people, this is what I've heard. Like, if you're buying and hoping it goes up, that's speculating. You're not really a good investor. You're hoping for appreciation. That's what amateurs do. And you need the cash flow from the get-go. Like, if it doesn't, it needs to pencil out from the door for you even. I know investors that look at it, will run the numbers and pass because they can't see where it'll pencil out. And so this is for my investors out there. Cash flow is everything.
Cash flow is everything. And I think when it comes to investing, side tangent, we'll get back on it, but we talk about in my group, the Lifestyle Investor Group, that you want to have JOMO a whole lot more than FOMO. So JOMO is the joy of missing out, while FOMO is the fear of missing out. And it is a whole lot better to miss out on 1,000 good deals than it is to get stuck in a bad deal.
All right, that's a bar there, guys. I hope y'all replay that one. That's a bar, because I see, because like, I'll take people through a whole cash flow and we call it economic model. And one time I was speaking at a real estate conference, like in last fall, and I was in between a hard money guy and a guy that helps people get business credit. And so it's a clip IG somewhere, or I think my wife recorded me, and I said, I want you to get business credit, but you should have your own bank. Like, just when I say your own bank, just a pool of capital that you control, so you have the choice. Do I want to use my money or their money? Because here's what I see with, I'm getting all this business credit. I am the one. This is how I said it. So I'm gonna say, like I said in the meeting, I was like, I'm back here cleaning all this shit up, right? Meaning that I'm looking at your financials and I see $100,000 of the business debt, but no business revenue, so now you've got no cash flow engine, and then you might have a job, but now you're paying for your personal debt and the business debt where you didn't get any business with it, and I see that day after day after day. Crazy, because I tell people, get your financial advice from TikTok, from IG.
Correct. You cannot. That is a recipe for
disaster, right? So let's about now. I want to get into a few cash flow control, and we kind of hit this. So, but there's a difference between, I don't think people know the difference. I think they're the same thing between budgeting and cash flow management. What is that difference to you?
I think that budgeting is looking at when I think, right, that is a lot more of like, let me report what I've done, right?
History.
Cash flow management is the actual structure and the reality of how your money moved, right? So what I talk a lot about is like most people put their budgets on Excel spreadsheet.
Yeah.
Budgets live on spreadsheets, while cash flow management brings that spreadsheet to life.
I love that. Okay. What does it mean? So this will get into what we it's kind of de facto mentor on a tool we call Currents, but what does it mean to not de facto, I don't know why I said that, but what does it mean to disconnect, and why is it important to disconnect spending from income?
Great question. And I think that goes back to the financial treadmill that I talked about a little bit earlier, where your income is deposited into your checking account, where all your expenses come out of, and you're unconsciously spending while trying to manually save. Like, it shouldn't be lost on us that corporations, financial institutions, and the government literally spend billions of dollars a year on marketing just to figure out how you can spend money better. Like,
Right.
you don't think that Apple was talking to all these other corporations to say, all you have to do, we're going to put this on the iPhone. All you have to do is double click the side of your phone and you're good to go. Like, they all know the best thing to do is make it easier to spend your money, right? Because most people, when you look at their life, all the friction is on saving money. For you to save money, if you don't have the right structure in place, you have to do the mental calculation to figure out what you need to save. Then you need to log into your bank account. So open your phone, look at your phone, open your phone, find the app, open the app, log into the app, go to the right bank account, figure out again how much you're mentally going to save, then go to the Move Money tab, then transfer the money to whatever account you think that you want to transfer it to, type in the number, mentally justify it again, and then finally hit the transfer button. Whereas spending, you walk into the store, you pick the thing up, you double click, and then you're good to go. Thank you for your service. We'll see you tomorrow. Right? So much friction is on saving money rather than spending money. And so the reason we want to disconnect spending from your paycheck is it's the first, I would say, the first key component of an optimal cash flow structure. But the reason we want to do that is so that the friction point now is on spending rather than saving. And if we can put more friction on spending than saving, we can get to financial freedom a whole lot faster.
I love it. What happens when income gets centralized instead of scattered across accounts?
So when you talk about that, so like, let's talk about, are we talking about a husband and a wife? Or are we talking about a bunch of different assets?
Well, hold on. All right. So let's two things. You just brought up another thing, right? So I was thinking reservoir concept, but before we go there, this is the other issue I have. Well, this is my money and this is her money, and never the twain shall meet. And
right.
Sometimes I don't know how to deal with that.
It's tough. Yeah. Let's first talk about the structure, like the optimal.
Yeah.
So when I think about an optimal cash flow structure, there's three things that I'm looking for. Number one is separation of income from expenses. And we do this by setting up what we call a cash flow reservoir. Okay. And we label it. We do that because what you don't label, you can't change. Okay, so we label your account, your cash flow reservoir. So now, number one, separation of income. Income is separation of income expenses. Your income is deposited into your cash flow reservoir. And then we only put in your checking account the money you need to spend out of your reservoir. Okay. So money flows in, money flows out. Income, number one key component. Number two key component is automation, and the right automations, not the wrong ones. You don't want the wrong automations. You want the right automations. Okay. We want to automate the money coming into your reservoir, and we want to automate a fixed dollar amount leaving your reservoir to go to your checking account for spending. And then third is we want a feedback loop. That's the third key component, is a feedback loop to tell us three things. Number one, how close to or above are we to our emergency fund or our reservoir target, right? 3 months of expenses is a good goal. The second is how much free cash flow do we have on an ongoing basis? Are we positive? Are we neutral? Are we negative? If it's negative, we got a problem. If it's positive, are we close to our 15% goal, right? The next is, I think, the most important is deviations, okay? We have a regular baseline spending that most people operate on each month, right? A regular baseline to allow you to live the life that you're living right now. And when you spend over and above that baseline, that is what we would call a deviation. Now, you need to know on this deviation, was this a one-time deviation? Like the washer and dryer went out and I got to pay for that, right? Or is this an ongoing deviation because we just looked and we realized, man, we've been spending $250 more than our baseline for the last 3 months. And we need to adjust. We either need to realize like that's our new normal and we spend that. So we need to adjust our baseline, or we gotta cut this out. Like we gotta rein in and get back on track to what we actually want to do. And so that's the most optimal cash flow structure: separation of income and expenses, having the right automations, and then having a real-time feedback loop.
I love that. Okay. Can you tell me, I followed Brock on LinkedIn, writes some great articles about a client or two that were making good money, but was constantly wondering where it all went. And I say that because we're having out, hopefully, no, it will be done this month, right? But then the topic, the title is, where did my money go? Okay.
Yeah.
Because when I run into people, I don't care if they make 50,000 a year or $500,000 a year. I don't know where money goes, right? Which is why we both think key is cash flow control. You know, all money is a result of, all wealth is as a result of cash flow. Do you have a few people that come to mind, examples of this?
Do I have a few? Yes. Majority of people, right? It is so common, so common. And funny is I was watching a training video from it was either the early 2000s or late 90s, where this training video was with a client, an advisor and a client. And the client said, they were walking him through like, what does he do for work and all these things. And he was a pilot. And he said, man, I thought that when I would make this money one day, all my problems would be gone and I'd be good to go. Like all my money worries would be fine.
Right.
But where I'm at, I'm finding that I feel like I have more money problems and I don't know where more of my money is at. And I see that over and over and over again nowadays, where you've to up to where you thought all your money worries would be gone. And you thought, man, life is going to be good, but more money, more problems.
That's right.
Right. And they have no idea where their money is at. Right. Because they aren't aware of it. They haven't been tracking it. They haven't been measuring it. So they can't improve it. And as that income continues to increase, and I say that, I feel like I say this way too much to people, but as your income increases, your expenses will increase if you do not have the right structure in place.
So I love that. So the let me segue into so we both talk so I first one of the things I talk about, you tell me, I think you do the same thing, we probably say it differently, but you gotta save 15% or more of your gross revenue. And then we talk about, okay, well, if you're going to save it, I got this question from Kim Butler: where do you store your cash? And then where's the best place to store the majority of your cash? So now, in your process, we've helped identify free cash flow. What's comes next?
Well, if I'm thinking about from an engineer perspective, right? If I'm building a building, I need to have a building with structural integrity. If I'm building a financial model, I need to have economic integrity, right? I got to have a plan that's going to work under any and all circumstances. So in my head, I roll through rules, right? So rule number one is, can I save 15% of my income, right? That's my goal, is just save some income, right? But my goal is 15%. The next is, do I have 3 to 6 months of expenses? Right? The next is maximum protection in all areas, mainly against the 3 catastrophic risks of life: lawsuits, disability, and death. The next is, I'll go to my debt. Do I have bad debt? If I have bad debt, can I make it to no debt because I have the cash to support that? Can I make it no debt? If I can't get no debt, how do I restructure, refinance, or renegotiate so that it becomes good debt, right? And to me, when I think about good debt and bad debt is rates, short pay periods, and not deductible. Whereas good debt is long pay periods, small interest, and it is deductible.
Okay.
Right. So those are the things that I want to roll through and get into with somebody. But then it's like, okay, well, now what do we do next? What's the next thing we do? Well, those are the areas where you look at on your financial life, where can you pick up the velocity of money, right?
Mm-hmm.
I'm not a huge proponent of retirement accounts, but if you have a match and you've taken care of the first 4 rules, maybe that's a good place for you to go, especially if you can get a Roth 401k, right? You may do a HSA or a Roth IRA if you don't have a match or if it's not that good, right?
Mm-hmm.
If you have that, well, then how do we go to a brokerage account where we can pick up stocks and bonds, right? And then we create income from your stocks and bonds, because with stocks and bonds, you can create income that's taxed more efficiently than your paycheck, which we talked about earlier, right? And so as that builds up, right, a lot of people want to be like, oh yeah, I want to buy these assets that's passive income. I want to too. That's my goal. Like, that is what I strive for.
Right.
However, not everybody's got the money to do that, right? To do that on a really good scale, you need to have $25, $50, $75, $100,000 plus of cash. Well, if you don't have that, areas that you can pick that up and start are within your business, brokerage account, and everything else. But you want to be building your buckets of money in the right way so that you're following those rules and matching your economic integrity within your model, having a balance of contractual and statement wealth, right? And that's a big where, you and I talk about it a lot.
Tell them about right there. Yeah. So I want to hear some coming from somebody else other than me. What's the difference between, explain contract wealth versus statement wealth? Because most people focus on statement wealth, and that's for the most part.
Totally. So statement wealth is when I take my money and I give it to an institution and they give me a statement back. But the risk is on me, not the institution, right? Because if you gave your money to a broker, he invested it, market goes down. Oh, sorry, it's the market, right? If you wait long enough, it'll come back, right? Whereas with contract wealth, giving your money to an institution and they're giving you a guarantee back, they're giving you that contract that states, hey, we are taking the risk for you and we will abide by our contract. And so the reason I talk about this a lot between statement and contract wealth is most people, this is one of my favorite quotes from you, I think, is when you talk about the strategy drives the product or whatever.
Oh, yeah.
And so, most people are out there buying products,
right?
70-30 portfolio, 60-40 portfolio, 80-20 portfolio, right? Well, what if instead of buying the product of the 70-30 portfolio, what if we built that through a strategy where maybe 100, don't sue me, this isn't financial advice, but maybe 100% of your money is going to the brokerage account, or if it's going to the brokerage account, it's 100% invested in equities, and the 30% is going to a whole life insurance policy, right, where it's contract wealth. And how does that operate into the future of which is better? So if you had, let's say if you're 10 grand a year, right, 7,000 would go to your investment portfolio, 3,000 would go to your whole life contract. Over time, that would continue to grow, and you would be able to rebalance and structure that to where you might end up at retirement with a whole lot more money supply and more benefits than the person who just bought the product of a 70-30 portfolio.
I love that. So so this is how cash flow management, and let's be specific so I understand. I was at some real estate conference, and I was a real estate group. It's like I talked about infinite banking. Hey, I heard you talk about infinite banking, but I thought you meant IUL. I was like, what? That's like a curse word. What are you talking about?
What are you doing?
Don't curse at me. And but so contract, because we want certainty, because when you look at so we're segue, because here's what I say, just so people haven't heard this before: principles drive strategy, right? So principle is how you think, your belief system. I like principles because principles don't change. They work no matter who works them. What's a principle? 10 commandments. Those are principles, right? If you read Rich Dad Poor Dad, the 7 keys for a lean purse. Those are principles, right? So principles drive strategy. I actually got this from Kim Butler. So this part I got from Kim. So I always like give their due. But strategy is what you do, right? And tactics are what you buy to fulfill the strategy. So if you're leading with most typical advisors, we're traditional, right? Even though it's not as traditional, most people are typical.
I got that from
Yeah, that's where I am. So but if so I'll tell people, look, the product should be a result of your knowledge, not a substitute for it, right?
Mm-hmm.
And so if you're leading, or if somebody leads a tactic after like 2 minute, 5 minute, or a video, they're, oh, you should get this annuity, oh, you should get this, da da da. They don't even know you. What's the strategy, right? So if I say, well, look, principle, save 15% or more of your gross income. That's a principle, right? Now, so the strategy we may call it is the private reserve, or be in the bank using permanent insurance. No. The strategy, I'm sorry, is mapping your cash flow so that you can find it, right? Because you can't, because if you don't control cash flow, what does Nelson say? What if you know what's going on, you know what to do? And so if you don't tell your money where to go instead of asking where it went, you can't do the tactic, which is maybe running a lot of it through properly structured dividend paying whole life as a place to store your liquidity, right? So it's boom, boom, boom. It's one, and they're in order. Like, there's not like, because a lot of people will go, and I used to make the mistake. Oh, I heard about this thing, and I would let them do it. I heard about infinite banking, and then it's like, all right, did you read the book? Do you, they don't know nothing. They think it's a magic money bottle. And so now I gotta slow them down to speed up, because you have absolutely no idea what you're talking. I had a client call one time. This is on the life insurance part. I want $1 million worth of life insurance. And if now she's in California, so I want to be able to borrow $500,000 so I could buy this whatever. I was like, what? You think because you bought $1 million of insurance you can borrow? And like 3 months later, I was like, no, that's here. You do read this and come back and see me, because you watch YouTube. Anyway, that's so we're not going to share stories. To think about this, I like the way you approach this. So if we use, because we both talk about permanent insurance being it's the turbocharger and not the engine.
That's right.
But it should be the foundation of good personal economy.
That's right.
Okay. And what is the biggest misconception people you think have about life insurance as an asset or an asset class? They don't see it as an asset; they see it as an expense.
Yeah, they see it as an expense, and I think that's the biggest thing. I think it's going to cost them something, right? But the reality is, the premiums that you pay in whole life insurance will be far less than the retirement income you miss out on when you don't have it, right? And what I'm talking about there is, if you show up at the day of retirement with no permanent insurance, right? You had term insurance and you canceled it. Your assets, your investments, that's the only approach you have, is an investment only approach. And now you are subject to the safe withdrawal method and out of control with the government, because you can't do anything about taxes. You're out of control with the market, because you can't do anything if the returns are so volatile. And you're out of control with the economy when it comes to inflation. You have no way around all of this stuff. Whereas if you showed up at the day of retirement, right, with a 1-to-1 ratio between a permanent death benefit and investments, you can move. You can pick and choose how you and when you possibly pay taxes. You can, by adding a permanent life insurance policy to your retirement portfolio, you can increase your distribution rate by 50 to sometimes 100%.
Wow.
Without it, right? And so you're going to pay life insurance premiums one way or another, either by lost income in retirement or premiums today. And premiums today are far, far less than what you lose out on in retirement income.
I'm glad you said that. I try to get that point across, and I'm asking stuff. I'll get somebody else to say it other than me. And thank you for that. So, because it's like like I come from a world where we used to talk about buy term investor difference. I was like, that is fiction. That does not work. First of all, because if you say
it works, it's not going to be optimal, right? Because that's what I talk about a lot. It's like if you go to the gym and you're just starting to work out, and you, like, at the beginning, you're learning your form, you're learning how to do a push-up, you're just doing body weight, you're just doing the beginner exercises.
Right.
If you do that your entire life, you might be fit, you might look okay, but you're not going to get stronger. You're not going to be of optimal health. You're not going to be performance ready. Whereas that's when you begin to do progressive overload. That's where you begin to build. You use weights, right? As you get bigger in wealth, as you get stronger in wealth, you need better strategies. You need to take daddy steps instead of baby steps.
Mm-hmm. I love it. I think that I forgot my other thought, but I want to. I'm looking at the clock, so I'm going to be respectful of your time. I want to talk to how what we're talking about, and I know a lot of your clients are small business owners, investors. How does this benefit them? How does this enhance their personal and their business economies, in your
Great
opinion?
question. It massively helps them, right? So business owners are worse than regular W-2 people when it comes to unconsciously spending and trying to manually save. Because in business, right, as money comes in and then we spend it, right, we justify it because we said, oh, no, I'm investing.
Mm-hmm.
Oh, really? Tell me the return. Tell me when you expect to receive a return on this investment that you just made with the dollars that you just spent.
That's a great question.
But the reality is, right, you're just spending money unconsciously as the business owner and then justifying it with the fact that you say, oh, well, I'm just investing my money into my own business. No, you're not. You're spending it unconsciously. It as a speculator. You're not even paying attention, right? And so as business owner, I would say that first, that's the first thing. It actually, like, it helps you in with what's going on, right? The next is it's going to make your bookkeeper and accountant's world so much easier. They're going to love you. They're going to thank you because you've finally separated the difference between personal and business expenses. And then the next, and this is probably the hardest thing for people to think about, is when you are a business owner, right? One day you might have the thought of exiting. One day. Well, when somebody comes and looks at your business and you're rolling in the dough and you're thinking, hey, I'm making 400 grand out of my business, you think that's your income. But when you look at the breakdown, you've got an executive income and you've got owner income. And the people buying your business are going to try and figure out, well, what are we going to have to pay an executive to come in here and do the job that he's doing?
Right.
Right. And so you've got to be able to separate, hey, here is me coming in working and I'm an employee, I'm an executive, but here's my income as a owner of the business. This is what I get to pull out as an owner. Right. And when you get to separate those two and you get to actually sit down and manage your cash flow the right way, your business valuation is probably going to go up. Your ability to manage your business goes up. Your ability to safely transfer corporate wealth to personal wealth is going to massively grow as well. Because it's kind of this weird dichotomy for business owners is our number one goal is to make as much money as possible.
Right.
Like the number one rule is to keep as little money in the business as possible. Right. And so you want to be able to do that the right way, the safe way, so that you're protected, you're growing your wealth, right? Because if you ask most business owners, you're like, all right, well, Curtis, you started your business. Did you start your business to grow your business wealth or your personal wealth?
Personal.
Well, if we're trying to grow your personal wealth, why do we keep money in the business? At what point do you plan on saying, hey, this is finally personal wealth? Because you may have started this business 10 years ago, and yet we're still working on business wealth.
Right.
Right. Some point you got to switch and do what you said you wanted to do.
So you got to move it over, because if you leave in the business, it's risky. It is at risk, a slip and fall, a lawsuit away from now. That's, so you want to move it out and have a separation. You got to separate church and state.
That's right.
And so many people commingle. One of the things I do when I kind of help them map cash flow, I like to start with their personal. How much is your life cost? So you can know what the business needs to pay you to live your ideal life. What is that? Because most people never figure that out. And then how do you take profit? And then what does it take? What does the business need to run? And so we could probably do this, they just segment their accounts on the business side also. That's another conversation for another day. But, it goes back to all wealth is a product of free cash flow or cash flow control. And I find that we just, and most typical advisors don't want to talk about that. They just want how much you got. We can do better. Why don't you give that money to us? Because their goal is AUM. It's not to make you rich per se. So not that we're railing on them. They do good people. They do good stuff, I guess.
But they're worried about their cash flow.
Right. And I want to ask you a couple quick fast round questions. Okay. What's the biggest money myth in your mind?
Whole life insurance is expensive.
Good answer. Favorite financial book?
Or you give what would Rockefellers do? Permission to Spend, Lifestyle Investor, Gap in the Gain, Lifetime Economic Acceleration Process. All the ones behind me.
Okay. Yep. And so let's say it again because I was talking.
What would the Rockefellers do?
What would Rockefellers do?
Permission to spend, the lifestyle investor, the gap in the gain, lifetime economic acceleration process.
Okay. What is the best lesson you took away from Nelson Nash?
A luxury once enjoyed becomes a necessity.
Yeah. Okay. And what would you say the business mistake affluent families make?
Not structuring their cash flow the right way.
What does financial freedom mean to you?
When your lifestyle expenses are paid for through your assets.
And that's what you're working on. I think it goes back to, I don't think people have, I always tell people it's hard to reach a target you don't have, right? And they don't have a target of financial freedom of, Daniel Priest says income follows assets, which we would call cash flow engines. And I don't think they're focused on that. They're just focused on income. Like if you look at financial gravity, right? Earned income. If you read, I always ask people, have you read Rich Dad Poor Dad? And they go, yeah, sort of a while ago. So what's the first lesson? Pay yourself first? No, it's the rich don't work for money.
That's right.
And they say, oh, that's right. Money works for them. That's not what that means. Okay. There's 3 types of income: earned, passive, and portfolio. So they don't work for earned income because who gets paid first? Everybody else. Your government, your voluntary benefits. It's like definitions. You got to understand. It's hard to win a game. You don't know the rules, right?
Words
and
matter.
Most of us, yeah. And so we're playing. What is one thing? I got one more last final question, and then I'm going to tell them where to find you. And him and I will probably do some work together. So if you get one of us, you get both of us. What's one thing every family should do in the next 30 days?
Audit their financial life or their cash flow and book a meeting with us so that we can help them structure their cash flow the right way.
There you go. And Brock, if a family is listening today between $150,000 and $500,000 a year, and they feel like they're doing everything right but not getting ahead, what's the first number they should look at when they get home tonight?
What's actually hitting their bank account?
What's actually hitting the bank account? Brock, so tell them about where to find you. You've got a great podcast. I'm listening to Cash Flow Legends, right?
Yep, Cash Flow Legends with a Z.
With a Z. What would you like to tell them?
Yeah, you can find me easiest on LinkedIn. I'm there almost every single day. It's a great place to introduce yourself, reach out to me, get on my calendar. If you want to reach out by email, just Brock at stonecenturyfinancial.com. And if you want a free copy of What Would the Rockefellers Do, you can go to book.stonecenturyfinancial.com.
All right. So, guys, I forgot what I was going to say, but this has been a fire call. I think, and there's so many gems there. This is like a listen to Morning White writer downer call because Brock gave y'all some serious gems in here. And I'm going to go back, let's do it and take notes. And then we both have so we'll work on in the notes of how we can kind of work together. I just wanted to really get him on and let you hear his brilliance, And my wife says, you got these young guys. I said, listen, I'm not, I have an ego, but I have no ego when it comes to business and money. Okay. So whoever's got the information, I'm going to get it. Right. Because my job is to get it and bring it back to you, which is the purpose of this show. So I want to thank you, Brock, again for sharing some time with myself, my listeners, and guys, go out there, send it to somebody that needs to hear it, and go out there and make it a great day. Brock, thanks again.